In this video, I want to talk about how to find undervalued stocks in 2025. You have some pockets in the market that are completely undervalued, and if you find these opportunities, you will make a lot of money this year. So I have some elements to share with you. In case you don't know me, welcome to this YouTube channel. My name is Christophe Nour, and I've been investing in the stock market for almost a decade, and I have achieved a performance of 25% per year investing in undervalued stocks. So now, what is an undervalued stock? You may think that it's a company stock with a low PE ratio. It's not often the case. Now, in 2024, we've seen a lot of inflows into AI, into tech, and there are companies that are out of favors. So the first element, if you want to find undervalued stocks, is to check, okay, what are the industries out of favor? Let me put OOF here. What is in favor? You have tech, you have AI, you have Meta, Google, Nvidia, everything related to chips. And on the opposite side of the spectrum, what is out of favor? Maybe I will let you a couple of seconds so you can think about it. In this process, I will exclude oil and gas. Oil and gas has often been out of favor, and oftentimes it's a little bit too complex, especially for what we preach on this YouTube channel. What is out of favor right now? You have industrials completely out of favor. You have some pockets of the housing market completely out of favor. Home building, construction companies out of favor. If you build some components to build some houses, out of favors. Companies that build windows, out of favor. Companies that sell bikes, out of favor. Lawn mowers in the US, out of favor. Right now I'm studying a company, TTC, Toro company. By the way, let me put the ticker symbol if you want to do an analysis here. The stock has done nothing for the past 3 or 4 years. Great business. It's a 100 bagger, but it's completely out of favor. Nobody wants to touch this stock. Same thing for Pool Corp. Pool, P-O-O-L. You have some companies out of favor because that can be scary and that's not sexy anymore. In 2025, what is sexy is AI, tech, the new US economy, etc. So first, how to find undervalued stocks is to check what are the industries that are out of favor. Now that you have identified these industries out of favor, by the way, I listed some of them, but you have plenty of other pockets that are completely undervalued. Once you have found some industries out of favor, you check the valuation. Okay, so now valuation, that's the easy way around. That's the P ratio. That's the price to free cash flow. And basically, you want to avoid companies with the PE ratio, price to free cash flow, above 20. So PE ratio below 20. Sorry for the writing, that's a pad. Or price to free cash flow below 20. And if you do this correctly, you will find a list of good companies growing earnings nicely, growing revenue nicely, nice management, nice moat, and they are trading at a fair value or cheap value. You can find some businesses that are trading at a rather cheap valuation. Let me just remove this again. Let me just put a V for valuation. It will be easier. Valuation. Now, a PE ratio of 6 doesn't mean it's cheap. If you have a PE of 6 and the earnings will decline next year, that's in reality a PE of 6 or above, like 8, 10, 12. So don't only look at cheap valuation, because if you think that PE ratios don't mean anything, that's mostly not the case. Bad companies will have a low PE ratio. Bad companies will have a PE ratio of 6 because these companies don't grow anymore. These companies are large, they pay dividends, no growth, they don't invest in the future. By the way, if you're looking for a complete framework to analyze stocks and build a strong portfolio, I have a coaching program. More on that at the end of the video. Now, how do you see if a company is cheap or not? You have a low PE ratio. That can be a good combination. Low valuation, high earnings growth. The sweet spot basically you want to have is a company that is in a out of favor industry with a cheap PE ratio, so let's say a PE ratio of 7, but large earnings growth, say 15% growth over the coming years. How can you know if a company will grow 15%? Either there will be estimates and the company will say that they plan to grow 15%, okay? Or you have sometimes some secured earnings in the future. Some business models sometimes are working this way. You have contracts in advance and you know how much money you will make in the future. So it's your work as an investor, stock picker, to do this work, to do this analysis and guesstimate what will be the free cash flow they will produce, the earnings they will produce. So let me put a third point here. That's still the earnings growth. If you combine these two elements, you will find some extremely good opportunities. And I remember a couple of years ago where I spotted this exact sweet spot in Williams-Sonoma. Let me put here, you can check, this was a PE ratio of 7, earnings growth that was completely decent. Everybody thought that the business would die and the margins will collapse. Guess what? It didn't happen. The earnings still went strong. EBIT margin like roughly 10-15%. They sell some furniture in the US, so home equipment, furniture. So that's some good elements here. And I will add something to the earnings growth is that sometimes you want to check growth catalysts that would increase drastically the earnings over the coming years. And it revolves around knowing your stuff. If you really know Williams-Sonoma, you know what they do, you know the management. Same thing with TTC, Toro, and Pool Corp. If you really invest in companies that you know really well, you've done the work, you know the growth prospects in the future, so you can identify the growth catalysts. Maybe you have an edge. That's why we invest only inside our circle of competence. Maybe you have an edge. Maybe you know more than Wall Street because you are familiar with the products. And maybe you can identify the growth catalysts before everybody else. And that's the perfect opportunity to buy and wait. Wait before the market picks up on these growth catalysts. So this is exactly what happened for Williams-Sonoma. Wall Street had a very bad guidance for this company. The estimates were quite bad. People thought that the company would decrease in earnings, and they improved earnings, they improved efficiency, so that went really well. And if you were familiar with their products, you could see this phenomenon. For furniture, they don't have discounts. The growth went really well. The traffic on their stores went really well. So sometimes you have key information to identify growth catalysts before everybody else. And I'm telling you, now in 2025, this market is driven by the Magnificent Seven. That means you have large inflows into tech, but sometimes you have large outflows from industries. Some industries are out of favor, and if you check inside these industries, the companies with large earnings growth, potential growth catalysts, trading at a low valuation, you can find amazing opportunities, companies that are cheap at the moment. If you like this content, I have an investing coaching program. In this program, you will learn a complete investing process. You will learn how to find good stock ideas, how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio with great companies. Additionally, in this coaching program, you will have access to my personalized guidance for long-term results. We will do weekly calls where we analyze stocks together, and you will have access to my private number available 24/7 for full support. If you have any questions, I'm here to help. Click the first link in the description below to get more information. You will get a short video that explains how everything works completely for free. No need for your mail address. Just click the first link in the description and I'll see you on the other side.